How to pick a winning stock. The financial industry would have you believe that you need to pay huge fees to financial advisors and Wall Street professionals to gain any advantage in the stock market, and to have them guide you on how to pick a winning stock. The whole marketing system for investing is geared towards making you, as an investor, think you don't have what it takes to successfully pick a winning stock in the stock market to make reasonable gains. In this video, I'm going to show you how to go about picking a winning stock. You don't need to have huge amounts of capital to invest to make any gains in the financial markets. What if I told you just investing $2,000 a year the right way could pave the way to financial success in retirement? Before we get into it, if you want to learn how to pick winning stocks, hit that subscribe button and comment, "I subscribed" below, so I know who's serious about increasing their financial well-being. Done? Great. Well, let's take a look at some of the methods which you can use to pick a winning stock. As always, I need to preface this video with the fact that I am not a financial advisor, and if you're looking to invest, you should consult a financial professional. To invest in a great stock, you first need to find a great company. In previous videos, we have said when investing in stock, you are buying a small portion of that business. As the company grows, so does your portion or share of this business. Your stock value will be based on how that business performs over the long term. If you look at some of the most successful businesses today, if you had invested in them for the long term, you would be sitting pretty good right now. Let's look at a successful company such as Apple, for example, and see where you would be today if you had invested in their IPO, initial public offering. Apple first sold shares to the public on December 12, 1980 at a price of $22 per share. Apple stock has split 5 times since then, 3 times at 2 for 1, once for 4 for 1, and 1 split at 7 for 1. This means that you would have received 2 shares for every 1 share you owned on the 2 for 1 splits, 4 shares for every 1 share you owned on the 4 for 1 splits, and 7 shares for every 1 share you owned on the 7 for 1 split. If you had bought only 1 share for $22, you would now have 224 shares today after the stock splits. The most recent split was in August 2020. So, without any growth, on the $122 share you bought in the IPO, it would be worth $4,928 just in stock splits, which isn't a bad investment, even if the share price stayed the same. That one investment of $22 would now be worth $32,032 at the current stock price of $143 per share. If you had invested $2,200 at the IPO, for easy figures, you would now be sitting on $3.2 million over the past 42 years. This is without investing another cent in Apple stock, just buying the IPO and leaving it grow for 40 years. The point I'm trying to make here is that all you need to do is find a good company with good fundamentals, good management, and a healthy-looking future, and put a relatively small amount into it, then forget about it for the long term. Try and pick out a company with a solid future and invest early. Take your time to really investigate the company and fully understand the business, how it makes money, and how it will benefit people in the future. Invest modest amounts of money into fewer businesses which you have done a lot of research on, rather than investing lots of money into stocks and shares here and there and everywhere and constantly trying to buy and sell and beat the market, because you won't be able to beat the market. Pick a business. Invest a modest amount early, then hold on for the long term. Think of investing in 10-year increments as a minimum. Don't ever invest with the intention of holding a business for a year or two. Most businesses can take 6, 7, 8 years or even longer to really start making gains. And if you're a short-term investor, this is where you're going to lose many of the huge gains which come from holding the stocks for the long term. Make sure you have the patience to ride out the markets for the long term. Stocks will go up and down. This is just the natural rhythm of the market. Sit back and accept it. On another note, you should only invest money which you have as disposable income. This way, if something happens in your life, you won't have to sell your shares when the market has just dropped to pay for your rent or a car repair in an emergency. Let's look at 5 things we can look at in a stock to determine if a business is a good investment or not. The first thing we need to look at is the company's sales and earnings growth. Is the company developing new products? Is the company selling more and more products? Try to understand the company's story and their goals for the future. Which direction are they heading with the business? Does a business have multiple streams of income, or are all their eggs in one basket? Are the sales revenues gradually increasing year on year? Are they in a pioneering industry which is going to be huge in the future? Or could some new revolutionary future product make their product obsolete? Consider all of these points above when looking for your next stock pick. If you manage to find a growth stock which increases its value by 25% a year, profits will double in 3 years, quadruple in 6 years, and will have increased 8-fold in 9 years. These are what we call growth stocks. The great thing with stocks that answer all the previous questions positively is that you don't have to jump into them right away. This is because you know they will be around for the long term. Secondly, you need to look at competitive advantages. What advantage does this business have over another? You need to do your research and really investigate why you would buy the products from this company over competitors. Talk to people and look at product reviews, and look at YouTube video reviews of the product. Are they positive or are they negative? How does the company handle customer service? Do they have a good reputation or a poor one? You need to establish where the company is positioned within the industry and where it sits amongst its competitors. Does this company offer a better product experience, or is the customer support better than the competition? Are the products of superior quality, or are they just a trend which may die out? Can the product be developed further to improve and adapt into the future market, or will it be obsolete when a competitor designs a new product? All of these things need to be considered when you're looking at the competitive advantages of a company to ensure that you pick a winning stock. If you are still watching this video, congratulations. You're one of the few who dedicates the time to become financially free. If you want to learn more about becoming financially free, then please hit the like button and subscribe. Done? Thanks. Let's carry on. Thirdly, you need to look at return on capital. This measures a return an investment generates for capital contributed. If you invest in a company's stock, you are a capital contributor. You are giving this business money in the hope that they will turn it into more money for you in the rise of the stock price or in dividends. So you need to look at what return on capital management were able to generate with previously invested sums to see if they are losing money on it or if they're making a healthy return. If they are making good returns, this usually means that they can continue to do so if they've had a good track record of being able to do so previously. As a rule, you're looking for a company which can provide 15 to 20% return on capital. If you find a company in this range or above, you need to consider investing in this company. Put a tick in the box and do some more research against the other 4 points in this list to properly evaluate the stock. Fourthly, you need to look at the valuation of the business. The valuation of the business is determined by the price to earnings ratio, which I'm sure you have heard of when looking at stocks. Let's say you own a coffee shop downtown. It costs you $100,000 to buy it, and it generates earnings of $10,000. The price to earnings ratio would be 10. How do you know if this is good or bad? Well, it depends on the industry. PE ratios need to be taken with a pinch of salt because there are other factors which need to be considered, including the potential for growth. PE ratios are only useful when you are comparing companies which are in the same industry. The PE ratio is a good metric to look at to see if a company is under or overpriced in the market. For example, a good PE ratio to look for before you start to look a bit further into the business is 20 to 25%. A stock with a PE ratio of around 10 would indicate that the stock is underpriced. A stock with a PE ratio of around 50 or greater would indicate that the stock is overpriced relative to the profit it makes. So aiming to find stocks with a PE ratio of around 20 to 25% is a good starting point for further research into a stock. And last but not least, you need to look at free cash flow. The free cash flow of a business is cash generated by the business minus cash used to invest in business, otherwise known as capital expenditure. This determines the free cash flow of the business. A company which generates free cash flow of 10% or more is considered good, and you should look for businesses which generate this level of free cash flow as a starting metric. An example of a company with a lot of free cash flow is Apple. They have hundreds of billions of dollars in free cash flow. In fact, they have so much they really don't know what to do with it. A nice position to be in. Other companies with a large free cash flow are companies such as Microsoft, ExxonMobil, and Amazon. While many of these businesses have already risen to meteoric highs, we need to be finding the emerging companies which also have a good free cash flow as early as possible in the life of the business. While many startups won't show a huge free cash flow early on, keep an eye out for the ones you think may in the future. And as the free cash flow starts to increase, then this could be the time to invest into these stocks, after doing further research on the points previously, of course. So, to recap this list of what you need to pick a winning stock, you need to look at the following. 1. Sales and earnings growth. Find a business which can increase its growth by around 25% a year. 2. Competitive advantages. Look for ways that the business is better than the competition and can continue to be better in the future. 3. Return on capital. Look for a 15 to 20% return on capital. 4. Valuation of the business. Look for a 20 to 25% PE ratio as a start to look further into the company. Do some more research into how the business can increase sales in the future. 5. Free cash flow. Look for a business which has at least 10% free cash flow. Using the tips I've set out above will put you on the right path and help you pick a winning stock. Good luck, and let us know in the comments which stocks you've picked. Have a look at this next video to keep on building your financial knowledge. Be sure to subscribe, and please share this video with a friend who's interested in the financial markets and wants to learn more about securing their financial future. I'll see you in the next one. Thanks for watching.